Welcome everyone. Today we're exploring Chapter 3.1, Financial Statements and Analysis, which is part of Unit 14, Financial Management for Agribusiness in Module 4. We'll learn how to understand and use the financial statements that are essential for running a successful agricultural business. Let's get started. Financial management isn't just about numbers. It's about transforming your passion for farming into a sustainable, profitable enterprise. This chapter is built around the essential pillars that will transform how you manage your agricultural business. First, we'll establish the foundations. You'll learn what financial statements are, why they're not just paperwork for the bank or tax authorities, but powerful tools that reveal the true health of your farm. Second, we'll dive into analysis. This is where the numbers come to life. You'll learn how to read these statements to assess profitability, evaluate liquidity, understand your debt position, and measure efficiency. We'll look at key financial ratios and what they mean for agricultural businesses. Remember, financial management transforms farming from hoping for success to planning for it. Let's begin this journey together. Let's begin with three fundamental concepts. First, financial management is the foundation of agribusiness success. Many people enter farming because they love the land, want to grow food, or continue a family tradition. But behind every successful agricultural operation lies solid financial management. Second, financial statements play a crucial role. They provide a clear, objective picture of your farm's financial health, much like a medical checkup for your business. They enable informed decisions about resource allocation, whether you're deciding between buying a new tractor or repairing an old one, or determining which crops deliver the highest profit margins. Third, understanding financial statements empowers you to navigate the complexities of farming. This knowledge is essential for achieving long-term sustainability. As we'll see throughout this presentation, in agriculture, where profit margins can be thin and risks from weather and markets are high, these financial insights aren't just helpful, they're essential for survival and growth. Why should you care about financial statements? Let me give you 5 compelling reasons. First, understanding financial health. Financial statements reveal your farm's condition through 3 key documents. The balance sheet shows if you own more than you owe, the income statement reveals your profit or loss, and the cash flow statement indicates your ability to pay bills when due. Without these, you're relying on feelings instead of data, and you might have high sales without realizing expenses are consuming all your profits. Second, guiding business decisions. Financial statements provide the data needed to allocate limited resources effectively. Should you buy a new tractor or repair the old one? Should you add a new berry field? Should you hire workers or invest in automation? Should you make equipment purchases in April during planting season or in October after harvest? Which crops deliver the highest profit margins? Third, securing financial support. Banks and investors require financial statements as proof of viability. For operating loans, your cash flow statement demonstrates repayment ability. For equipment loans, your income statement proves you can cover payments. For land financing, your balance sheet assesses your debt capacity. These documents are also required for grant applications. Fourth, tracking progress toward goals. Whether it's income growth, debt reduction, or improving winter cash flow, financial statements help you measure progress and adjust strategies. Fifth, early warning system. Financial statements identify potential problems before they become crises, like noticing cash shortages before harvest, identifying consistently unprofitable crops, or spotting increasing debt to asset ratios. In agriculture, where margins are thin and risks high, catching a 30% feed cost increase early can save your business. Before we dive into each financial statement, let's understand what they are and why they follow a standard format. Financial statements are standardized reports that document your farm's financial activities and performance. Think of them as the official language of business finances. They follow established accounting principles that make them understandable to banks, investors, and other stakeholders. The three primary financial statements are: the balance sheet provides a snapshot of assets, liabilities, and equity at a specific date, like taking a photograph of your financial position. The income statement summarizes revenues and expenses over a period, showing whether you made a profit or loss. It's like a video of your financial performance. The cash flow statement tracks actual cash inflows and outflows, which is critical for managing liquidity. This shows you whether you'll have money in the bank to pay your bills, which isn't always the same as being profitable. The objective of financial statements is to provide financial information about your business's assets, liabilities, equity, revenue, expenses, and cash flows. This information is useful to many stakeholders: banks deciding on credit approval, suppliers deciding whether to sell to you, tax authorities determining what you owe, investors evaluating opportunities, and most importantly, you as the owner making strategic decisions. Let me explain the three core concepts that financial statements measure: financial position, financial performance, and cash flow. Financial position is the status of your financial health at a specific point in time, like a snapshot. It shows what you own, assets, what you owe, liabilities, and your ownership stake, equity. The balance sheet is the primary statement for this, using the key formula: owner's equity equals assets minus liabilities. Financial performance measures how well you generate revenue, manage costs, and create value over a period. The income statement, also called the profit and loss statement, is your primary tool here. It uses the formula net income equals revenues minus expenses. This tells you whether your operations are profitable. Cash flow tracks the actual money movement in and out of your business over a period. The cash flow statement divides this into operating activities, your core business, investing activities, buying or selling equipment and land, and financing activities, loans and payments. The key formula is net cash flow equals cash inflows minus cash outflows. A critical warning here: income doesn't equal cash. Profitable businesses can fail without cash. This is especially true in agriculture, where you might record revenue when you sell crops in October, but not receive payment until December. Understanding this difference is crucial for survival. Now let's explore the balance sheet in detail. The balance sheet reports your farm's assets, liabilities, and equity at a specific point in time. It provides an image of what a company owns and owes, as well as the amount invested by its owners. In other words, the balance sheet reflects the financial position of a company. The three main components work together. Assets represent what you own: land, equipment, cash, and inventory. Liabilities encompass what you owe: loans, bills, and other obligations. Equity reflects your ownership stake, the part of the assets of the company that is financed by its owners. The balance sheet follows a simple formula that derives from the fundamental accounting equation, that is, the net worth, or the equity, equals assets minus liabilities. Here's a practical example. Maria's small organic vegetable business has 25,000 euros in her checking account, 8,000 euros worth of stored winter squash, a tractor worth 15,000 euros, and 5 acres of land valued at 150,000 euros. Her total assets are 198,000 euros. She has a 10,000 euro operating loan and owes 100,000 euros on her land mortgage, for total liabilities of 110,000 euros. Therefore, Maria's equity, what she truly owns, is 88,000 euros. This is calculated by subtracting her liabilities from her assets. 198,000 euros minus 110,000 euros equals 88,000 euros. This equity represents her true ownership stake in the business and shows her financial strength. How did we come to this conclusion? By separating the information about Maria's business based on the components of the balance sheet. Let's break down assets into their components. Assets are resources controlled by your farm as a result of past events that are expected to generate future economic benefits. Understanding the definition is crucial. An asset is a resource that must be controlled by the enterprise as a result of past events, and future economic benefits must be expected to flow from it. Your business must have control and power to direct usage, obtained from a past transaction or event. For example, you can't count your neighbor's land as your asset even if you rent it because you don't own it. Assets must provide future cash flows, cost savings, or operational advantages to qualify. They are classified into two main categories: non-current and current. Non-current assets are long-term resources used over multiple years. Land and buildings that provide your production base, machinery and equipment that enable operations, breeding livestock that generate offspring year after year, and perennial crops like orchards and vineyards that produce for many years. These are essential for sustaining farm operations over an extended period. Current assets are resources that will be converted to cash or used within 1 year. Cash in bank accounts for immediate needs, harvested crops in storage waiting to be sold, market livestock ready for sale, prepaid expenses like insurance paid in advance, and accounts receivable from customers who haven't paid yet. Now, let's look at the other side of the balance sheet: liabilities, or what you owe. Liabilities are current obligations arising from past events that require future outflows of resources to settle. They're divided into two categories based on timing. Current liabilities are debts due within 1 year. Operating loans for day-to-day expenses, the current portion of long-term debt, this year's payments on multi-year loans, accounts payable to suppliers, and accrued expenses like wages owed to workers. Non-current liabilities are long-term debts. Property mortgages typically spread over 15 to 30 years, equipment loans usually lasting 5 to 10 years, and long-term lease obligations. Liabilities can also be classified by nature: financial liabilities like bank loans, commercial liabilities owed to suppliers, fiscal liabilities for taxes, payroll liabilities for employee compensation, and miscellaneous obligations like legal settlements. Managing liabilities is crucial for two reasons. Maintaining solvency means ensuring you can meet long-term obligations, and maintaining financial flexibility means having the capacity to take on new debt if opportunities arise. The key is balance. Too much debt creates risk, but strategic debt can fuel growth. Equity is the part of the assets of a farm that is financed by its owners, or what remains available to the owners after all liabilities are settled. In simple terms, it's what's truly yours. Using Maria's example from earlier, her assets of 198,000 euros minus liabilities of 110,000 euros equals 88,000 euros in equity. The main components of equity are share capital, the owner's contributions to the establishment of the company; share premium, extra amount paid above the face value of shares; reserves, profits set aside for specific purposes or legal requirements; retained earnings, accumulated profits from previous years; current result, this year's profit or loss. Equity is significant for several reasons. It indicates the value you've built in your business over time. This could be through retained profits, asset appreciation, or paying down debt. It's critical for assessing your financial strength and your capacity to borrow more if needed. Banks look at your equity position to determine how much additional debt you can safely handle. Equity serves as a measure of your farm's financial stability and highlights the resources available for future growth and investment. Strong equity provides a cushion against losses during difficult years and gives you the flexibility to invest in new opportunities. It's also what you'll pass on to the next generation or receive if you sell the business. As the saying goes in farming, equity is what you build when you're young so you can live on it when you're old. Moving from the balance sheet to the income statement. This document shows whether your agricultural business is profitable over a specific period, typically a year. The basic formula is elegant in its simplicity. Net income equals revenue minus expenses. But understanding what goes into each component is where the complexity and insight lie. The income statement's purpose is to summarize revenue and expenses to show the company's net profit or loss, helping stakeholders understand profitability and overall business health. Unlike the balance sheet, which is a snapshot, the income statement is like a video. It shows what happened over time. Let me give you an example. In 1 year, Maria's vegetable business had 85,000 euros from vegetable sales and 5,000 euros from farm tours for total revenue of 90,000 euros. Her expenses were 45,000 euros for seeds, supplies, utilities, labor, and other operating costs. Therefore, her net income was 45,000 euros. But here's the critical point. Net income on the income statement doesn't tell you whether you have cash in the bank. Because of accrual accounting, you record revenue when you earn it, not when you receive cash, and expenses when you incur them, not when you pay. This is why you need all three financial statements working together to understand your business fully. Understanding revenue is more complex than it first appears. Revenue is the economic benefit earned from providing goods or services, and it's recognized when measurable and earned, not necessarily when cash is received. In agriculture, revenue comes from several sources. Operating revenue includes crop and livestock sales, value-added products like cheese or jams, agricultural services such as custom work or agrotourism, and government payments and subsidies. Financial revenue stems from activities related to financing, investment income, and exchange rate variations. The timing of revenue recognition follows 4 scenarios. First, production-based revenue is recorded when agricultural goods are produced and recorded at production costs. Second, sales and service revenue is recognized when legal property rights transferred to the buyer or services are provided with future payment. For example, you sell 20,000 euros worth of corn in October but won't be paid until December. You still record the revenue in October. Third, direct cash sales are recorded when immediate cash transactions occur. Fourth, estimated to certain revenue are recorded when previously estimated revenues become certain. This accrual basis of recognizing and recording revenue is crucial. You record revenue when transactions happen, not just when money moves. This gives a more accurate picture of your business performance, even though it means revenue doesn't equal cash in the bank. Now let's examine the cost side of the income statement. Expenses. Expenses are costs incurred to generate revenue, recognized when measurable and incurred, not just when paid. They include operating expenses like seeds, feed, fertilizers, labor, utilities, repairs, insurance. Financial expenses encompass interest on loans and foreign exchange losses. Similar to revenue, expense recognition follows 4 patterns. First, consumption of goods in operations, such as storable inputs like seeds, feed, and fertilizers used in agricultural activities. Second, when the expense incurs, such as non-storable goods like water and electricity, or services recorded simultaneously with supplier obligations. Third, direct payment for expenses where payment and expense recognition happen simultaneously. Fourth, estimated expenses incorporation for deferred expenses, depreciation, and provisions based on the accrual accounting principle. Here is a critical example of this timing difference. You buy 30,000 euros worth of seeds in March and pay cash immediately. Under cash accounting, you would record the expense in March when you paid. But under accrual accounting, you don't record the expense when you buy the seeds. You record it when you use them. So if you plant those seeds in April, that's when the expense is recorded because that's when you actually consume the resource. This accrual principle means you record expenses when they're incurred, when you use the inputs, not when you pay for them. Similarly, you record revenue when you earn it by delivering products or services, not when you receive payment. This matching of when things actually happen rather than when cash changes hands gives you a true picture of your business performance. Let's bring revenue and expenses together to understand net income. Net income or loss is the difference between total revenue and total expenses, including income tax expenses. However, fiscal rules usually apply to the precise determination of net income. This value helps stakeholders understand profitability and overall business health. Positive net income means you made a profit. Your business generated more revenue than it consumed in expenses. A negative net income or net loss means you spent more than you earned. But remember 3 important caveats. First, net income doesn't equal cash flow. You can be profitable, but have no cash if customers haven't paid you yet. Second, 1 year's net income doesn't tell the whole story. You need to look at trends over multiple years. Third, net income can be manipulated through accounting choices, so understanding the components is crucial. For farmers, net income must be substantial enough not only to cover family living expenses, but also to reinvest in the business and build equity for the future. For the final part of our trip through financial statements basis, we will focus on the cash flow statement. For agricultural entrepreneurs, the cash flow statement is arguably the most critical of the 3 financial statements because it tracks when money actually moves in and out of your accounts. With seasonal income but year-round expenses, maintaining positive cash flow is critical. Cash flow reflects your ability to generate enough cash to operate, pay debts, and invest. There are 2 types of cash movements. Cash inflows are cash and cash equivalents received, such as product sales when payment is actually received, loan proceeds, capital contributions, tax refunds, and government payments. Cash outflows are cash and cash equivalents paid, such as operating expenses when actually paid, loan payments including both principal and interest, capital purchases, and tax payments. Here's a practical example. Maria's agricultural business generates most income from June through October, but she needs to purchase seeds and supplies in February and March. Her cash flow statement helps her determine how much money to set aside from harvest season to cover early season expenses or whether she needs a seasonal operating loan. The cash flow statement complements the other 2 statements but differs from them. Unlike the balance sheet, it shows changes in cash over time. Unlike the income statement, it excludes non-cash items and focuses on actual cash movement. This is your survival document. You can be profitable on paper but go bankrupt if you run out of cash. The cash flow statement is divided into 3 sections corresponding to the 3 functions of a company: operating, investing, and financing. Operating activities represent cash movements from core farm operations, including sales receipts when you actually receive payment and operating expenses when you actually pay them. These activities are crucial for understanding the day-to-day liquidity of your farm. If your operating activities consistently generate negative cash flow, your core business model has a problem. Investing activities involve cash flows related to buying or selling long-term assets, such as equipment purchases and sales, land acquisitions or sales, and improvements to buildings or infrastructure. Negative cash flow in investing activities isn't necessarily bad. It often means you're growing and modernizing. These activities help in planning investments and assessing asset management. Financing activities encompass cash flows involving borrowing and repayments, including new loans received, principal payments on existing loans, and interest payments. Understanding these activities aids in structuring financing effectively. Positive financing cash flow means you're borrowing more than you're paying back, increasing leverage. Negative means you're paying down debt faster than taking on new debt. At the end of the statement, the net cash from each section is summed to show the overall increase or decrease in cash during the period. This value, added to the beginning cash balance, provides the ending cash balance, which should match the cash amount on your balance sheet. Now that you have got a basic understanding of what financial statements are and what information they each provide, let's talk about some special considerations for new agribusinesses. New agricultural businesses face unique financial management challenges that require specific strategies. First, asset valuation strategies. Use recent purchase prices or local market values for land and buildings. For equipment, use the purchase price minus depreciation accumulated over its useful life. For livestock, use market value by type and purpose. Breeding stock is valued differently than market animals. For growing crops, value them based on invested inputs accumulated so far. Second, managing seasonality challenges. Keep 3 to 6 months of operating expenses in cash reserves to navigate seasonal fluctuations. This cash buffer is your safety net. Diversify products for year-round income when possible. Maybe add a winter crop, value-added products, or agritourism. Schedule major purchases post-harvest when you have cash available. Use seasonal loans to cover gaps, but plan carefully to ensure harvest revenue will repay them. Third, separating personal and business finances. Open separate business accounts to avoid confusion. Pay yourself a regular draw, as if you were an employee, rather than randomly pulling money when needed. Track any personal assets used in the business, like your truck or home office. Fourth, using financial statements for decisions. When considering expansion, check if profits and cash flow support it and assess the debt impact. For equipment decisions, evaluate if revenue gains or cost savings justify the expense, and consider leasing or outsourcing as alternatives. Before we move to the next section, let me walk you through the 4 steps to create your first agricultural financial statements. Step 1. Building your balance sheet. List all assets, land, equipment, livestock, crops, cash, and all liabilities, loans, bills due, mortgages. Calculate your equity using the formula assets minus liabilities. Don't worry about being perfect. Accuracy improves with practice. This provides a clear snapshot of your financial position and establishes your baseline. Step 2. Tracking revenue and expenses. Use a simple system to record all revenue and expenses. This could be a dedicated business checking account, a spreadsheet or paper ledger, basic accounting software, or agriculture-specific software like Farm Books or QuickBooks for farming. Create a month-by-month projection of expected income and expenses for your first year. Update it with actuals as they occur. This ensures you stay on top of your financial performance and can spot problems early. Step 3. Managing cash flow. Develop a monthly cash flow budget to manage seasonal cash movements. Project when cash will come in from sales and when it will go out for expenses. Identify your cash crunch periods, usually spring planting when expenses are high but no revenue is coming in yet. This helps you plan for periods of high and low cash availability and know when you need operating credit. Step 4. Regular financial reviews. Set aside time monthly to update your financial records. Reconcile your bank account, record all transactions, update your cash flow projections. Conduct thorough quarterly reviews of all 3 financial statements. This practice enhances accuracy and supports informed decision-making. The monthly reviews keep you current, while quarterly reviews let you see trends and make strategic adjustments. Now we move from understanding financial statements to analyzing them for performance insights. Financial performance analysis is critical for evaluating your farm's health, identifying strengths and weaknesses, and guiding strategic decisions. It accounts for agriculture's unique traits, seasonal production cycles that create fluctuating cash flows, susceptibility to environmental factors you can't control, high capital intensity requiring major investments, and distinct revenue patterns concentrated in harvest periods. This holistic approach integrates several analytical methods. Ratio analysis compares different financial metrics to reveal relationships and trends. Benchmarking measures your performance against industry standards and peer farms. Trend evaluation looks at how your metrics change over time, distinguishing between temporary fluctuations and fundamental shifts. These methods work together to enhance financial literacy and operational resilience. Financial ratios are meaningless in isolation. You need to compare them to something. Is a 5% profit margin good or bad? It depends on your industry, your past performance, and your peer group. By combining ratio analysis, benchmarking, and trend evaluation, you build a complete picture of your farm's financial health and identify specific areas for improvement. As we'll see, agriculture-specific financial considerations are central to this analysis. Seasonal cycles affect liquidity needs. Environmental risks impact profitability, variability. Capital intensity influences return on asset calculations. Revenue patterns shape cash flow management strategies. Let's begin our detailed ratio analysis with profitability metrics. Profitability analysis examines your farm's ability to generate returns in excess of expenses. We will explore 4 key profitability metrics. First, operating profit margin measures operational efficiency and pricing power, showing what percentage of revenue remains as profit after covering all operating costs, but before considering how the operation is financed. Understanding the performance thresholds is essential for benchmarking. Operating profit margins above 20% represent strong performance, indicating excellent cost control and pricing. This is the target zone for highly efficient operations. Margins between 10% and 20% are considered good, representing acceptable profitability levels. Moderate performance falls between 5% and 10%, suggesting room for improvement in either revenue enhancement or cost reduction. Margins below 5% indicate poor profitability requiring immediate attention. The operation is barely covering its costs. The operating profit margin is particularly useful for comparing profitability across different farm enterprises or between farms of different sizes. This ratio also helps identify potential problems. If profit margins are declining over time, it might indicate rising costs that aren't being offset by revenue increases, or it might suggest that revenue is falling while costs remain sticky. Either situation requires management attention. Farmers can improve operating profit margins through 2 approaches: increasing revenue per unit through better quality, timing, or marketing strategies, or reducing per unit costs through improved efficiency, better input management, or economies of scale. The second indicator is return on assets. Return on assets measures how effectively the farm generates profit from its total asset base. Why is return on assets so important in agriculture? Farming is extremely capital intensive. When you consider the value of land, buildings, machinery, and working capital, total assets in a farm operation can easily run into millions of euros. This ratio tells us whether those assets are generating adequate returns. Understanding the performance benchmarks is crucial. According to industry standards, a return on assets above 8% indicates strong performance. Between 5% and 8% represents good performance. Moderate performance falls in the 2% to 5% range, while below 2% suggests poor returns that may not justify the capital invested. It's important to benchmark ROA against similar farms in the region. as what constitutes optimal performance can vary by farm type and location. A grain farm might have different expected returns than a dairy operation, and farms in high-cost land areas face different benchmarks than those in lower-cost regions. Understanding return on assets helps farmers make strategic decisions about capital investments and overall business strategy. If your ratio is consistently below 5%, it's time to examine whether assets are being utilized efficiently or whether profitability improvements are needed. Third, return on equity evaluates returns on the owner's capital, while return on assets looks at returns on the total capital employed in the business. Return on equity specifically measures the return generated for the farm owners on their equity investment. According to agricultural finance standards, return on equity above 12% indicates strong performance. This represents excellent returns on the owner's invested capital. This ratio is particularly relevant for farm owners when making decisions about whether to keep capital invested in the farm or to invest elsewhere. Generally, it should be higher than the return on assets for the same farm. Why? Because of leverage. If a farm borrows money at, say, 5% interest, but can generate returns of 8% on those borrowed funds, the owners benefit from the difference. When evaluating return on equity, consider it alongside return on assets and the farm's debt-to-asset ratio. Together, these metrics reveal how effectively the farm is using both equity and debt capital to generate returns for the owners. Finally, earnings before interest, taxes, depreciation, and amortization shows core profitability before financial and accounting adjustments. This is useful for comparing farms with different financing and depreciation structures. Let's now transition to liquidity analysis, which examines a farm's ability to meet short-term financial obligations. While profitability tells us whether the farm is making money, liquidity tells us whether the farm can pay its bills on time. Liquidity is critical in agriculture because of the seasonal nature of production and income. Most farms have significant expenses throughout the year but concentrated income at harvest or when livestock are sold. This creates liquidity challenges that must be managed proactively. Inadequate liquidity is one of the most common reasons farms face financial distress, even when they're fundamentally profitable. A farm might show a profit for the year, but if it can't access enough cash to pay for seed and fertilizer in the spring, it won't matter that a profit is expected in the fall. There are 4 key liquidity metrics we'll examine: current ratio, working capital to gross revenue ratio, and defensive interval. Each provides a slightly different perspective on the farm's short-term financial position. The current ratio is calculated by dividing current assets by current liabilities and indicates whether the farm has enough liquid resources to pay its short-term obligations. A ratio of 2.0 means the farm has €2 of current assets for every euro of current liabilities. When evaluating the current ratio, consider seasonal variations. A grain farm's current ratio will naturally be highest right after harvest when inventory and cash are at peak levels, and lowest in spring when inventory is depleted and planting expenses have been incurred. This is why it's important to look at current ratio trends over time and understand the seasonal patterns. Also consider the composition of current assets. A current ratio of 2.5 looks very different if most current assets are cash versus if they're inventory. Cash is immediately available while inventory must be sold first. The current ratio is a good starting point for liquidity analysis, but as we'll see, other metrics provide additional insights. Working capital is simply the money difference between current assets and current liabilities. If you have €500,000 in current assets and €200,000 in current liabilities, your working capital is €300,000. This represents the cushion of liquid resources available to the business. While the current ratio looks at the relative relationship between current assets and liabilities, working capital gives us the absolute money amount of that cushion. As a rule of thumb, working capital should cover approximately 30% of annual operating expenses. The working capital to gross revenue ratio takes this a step further by expressing working capital as a percentage of total revenue. This ratio should typically be at least 20% to 30% in agriculture. This metric is particularly useful for comparing farms of different sizes since it's a proportional rather than absolute measure. The defensive interval is calculated by dividing liquid assets by average daily operating expenses. The result tells us how many days the farm could operate without any new cash inflows. For example, a defensive interval of 90 days means the farm could continue operations for 3 months using existing liquid resources before needing additional income. In agriculture, a defensive interval of 60 to 90 days or more is generally considered healthy. This provides adequate cushion for the seasonal gaps between major income events. A defensive interval below 30 days suggests vulnerability to cash flow disruptions. The farm has very limited liquid reserves to weather any interruption in cash inflows. The defensive interval helps answer the question: if our revenue suddenly stopped, how long could we keep operating? This is important for scenarios like major market disruptions, weather disasters, or health issues affecting the operator's ability to work. Improving your defensive interval involves either increasing liquid assets or reducing daily operating expenses. Building cash reserves during profitable periods is the most direct approach, though this must be balanced against other capital needs and investment opportunities. Good liquidity management involves several strategies. Maintain adequate working capital, the cushion of current assets over current liabilities, carefully time major purchases and debt payments to align with cash inflows, establish lines of credit before you need them, so funds are available when necessary. Build cash reserves during profitable years to buffer against lean years. Liquidity management also requires good cash flow projections. You need to anticipate when cash will be tight and plan accordingly. Remember, liquidity and profitability are different dimensions of financial health. A farm can be highly profitable but illiquid, or liquid but unprofitable. You need both for sustainable success. Now let's shift our focus from short-term liquidity to long-term solvency. Solvency analysis evaluates a farm's capital structure and its ability to sustain long-term financial health, while liquidity examines whether you can meet obligations due within the next year. Solvency examines your overall financial structure and whether it's sustainable over the long term. A farm might have adequate liquidity today but still face long-term solvency problems if it's over-leveraged. Solvency is fundamentally about the relationship between debt and equity in the business. How much of the farm is owned by the operators versus how much is owed to creditors. This relationship determines the farm's financial resilience and flexibility. The 4 key solvency metrics we'll examine are the debt-to-asset ratio, the equity-to-asset ratio, the debt coverage ratio, and the replacement margin. Each provides important insights into the farm's capital structure and long-term sustainability. The debt-to-asset ratio is calculated by dividing total liabilities by total assets, expressed as a percentage. This tells us what proportion of the farm's assets are financed by debt. For example, a ratio of 40% means that 40% of asset value is financed by debt, while 60% is financed by owner's equity. The equity-to-asset ratio is simply the complement of the debt-to-asset ratio. It shows what percentage of assets are owned outright. If debt-to-asset is 40%, then equity-to-asset is 60%. An equity-to-asset ratio above 60% reflects a solid equity base and strong financial position, corresponding to the good to strong solvency categories. Why is a strong equity position so important in agriculture? Several reasons. First, agriculture faces significant risks from weather, markets, and policy changes. Strong equity provides a buffer against these uncertainties. Second, farm assets, particularly land, can fluctuate in value. If asset values decline while debt remains constant, highly leveraged farms can quickly find themselves underwater where liabilities exceed assets. Third, lenders typically require certain minimum equity positions as conditions for lending. However, equity position alone doesn't tell the complete solvency story. A farm with 70% equity might still face problems if it has inadequate income to service its debts. This is why we need to look at debt coverage metrics as well, which we'll discuss next. The debt coverage ratio measures the farm's capacity to meet debt obligations from operational income and tells us how many times over the farm's income can cover its debt payments. The beauty of this ratio is that it considers both the farm's income-generating capacity and its debt burden. A farm might have low leverage with a good debt-to-asset ratio, but still have poor debt coverage if income is insufficient. Conversely, a more highly leveraged farm might have excellent debt coverage if income is strong. Farms should target the good to strong range of 1.5 or higher for sustainable debt servicing. The replacement margin is a more comprehensive measure that indicates whether income is sufficient not just to pay debts, but also to replace depreciating assets and meet the owner's living expenses. A replacement margin above 1.0 indicates the farm is generating enough income to meet all these obligations and maintain its asset base. The farm can fully replace depreciating equipment and buildings while servicing debt and supporting the family. A margin below 1.0 suggests the farm is gradually liquidating its asset base or deferring necessary replacements, neither of which is sustainable long-term. The farm is consuming capital rather than maintaining it. These income-based solvency metrics are particularly important for evaluating whether a farm's capital structure is appropriate for its income level. It's possible to have too much debt, even with a seemingly acceptable debt-to-asset ratio, if income isn't sufficient to service that debt comfortably. When analyzing solvency, always look at the complete picture. Both the static measures of capital structure, like debt-to-asset ratios, and the dynamic measures of income adequacy like debt coverage and replacement margin. Together, these provide a comprehensive view of long-term financial sustainability. Strong solvency is crucial for several reasons. It provides a financial cushion against adversity. Farms with strong equity positions can better weather years of losses or market downturns. It enhances borrowing capacity. Lenders are more willing to extend credit to farms with strong equity positions. It provides flexibility for strategic decision-making, allowing the farm to take advantage of opportunities or make necessary changes. Solvency positions develop over time, often across generations in agriculture. Building equity is a long-term process that requires patience and disciplined financial management. Now let's turn to our final category of financial analysis, efficiency metrics. While profitability tells us how much money the farm makes, efficiency metrics tell us how well the farm utilizes its resources to generate that revenue and output. Efficiency analysis is crucial because agriculture is a resource-intensive business. Farms deploy significant capital in land, buildings, machinery, and working capital. They use substantial labor inputs. They manage complex biological and production processes. How effectively these resources are utilized directly impacts both profitability and competitiveness. Efficiency metrics are particularly valuable for benchmarking against similar farms and identifying opportunities for improvement. If your operating expense ratio is significantly higher than comparable farms, that suggests potential for cost reduction. If your yield per hectare is below regional averages, that might indicate agronomic or management issues to address. There are several key efficiency metrics: asset turnover ratio, operating expense ratio, machinery investment per hectare, yield per hectare, and labor efficiency. Each provides insights into different aspects of resource utilization. The asset turnover ratio measures revenue generated per euro of asset value. Asset turnover varies significantly by farm type. Livestock operations typically have higher turnover than crop farms because they have lower asset requirements relative to revenue. Intensive operations generally have higher turnover than extensive ones. Understanding industry benchmarks for your specific type of operation is important. The operating expense ratio shows the percentage of revenue consumed by operating costs. This ratio is particularly useful for identifying cost problems. If your operating expense ratio is rising over time or is significantly higher than comparable farms, it signals the need to examine specific cost categories for potential savings. Machinery investment per hectare measures capital invested in machinery relative to land area. This metric helps identify whether the farm has overinvested or underinvested in equipment. Yield per hectare measures physical output per unit of land, indicating production efficiency. While market prices affect profitability, yields are under more direct management control. Comparing yields to regional or varietal potential helps identify whether agronomic practices are optimizing production. Labor efficiency measures revenue generated per full-time equivalent worker. This highlights workforce productivity and helps evaluate whether the operation is appropriately staffed. Labor is expensive, and ensuring it's used productively is essential for competitiveness. It's important to note that efficiency and profitability don't always move together. A farm might be highly efficient in certain areas while still being unprofitable due to market conditions or strategic choices. Conversely, a farm might be profitable despite inefficiencies if it benefits from exceptional land quality or favorable circumstances. Improving efficiency often requires capital investment. More efficient machinery might require equipment upgrades. Better yields might require investments in irrigation, precision agriculture technology, or tile drainage. The key is ensuring that efficiency investments generate returns that exceed their costs. Efficiency analysis should be an ongoing process, not a one-time exercise. Regularly monitoring efficiency metrics and comparing them to benchmarks helps identify emerging problems before they become serious and opportunities for continuous improvement. As we near the end of our session, let's take a moment to synthesize what we've covered and emphasize the importance of comprehensive financial analysis. Effective financial management in agribusiness requires looking at the complete picture. No single financial metric or statement tells the whole story. You need to examine profitability, liquidity, solvency, and efficiency together to truly understand a farm's financial health and performance. Financial analysis should drive action, not just generate numbers. The purpose of this analysis is to identify problems before they become crises, recognize opportunities for improvement, and guide strategic planning. Make financial analysis a regular part of your management routine, not just something done once a year for the lender. Finally, remember that financial metrics are tools to help you manage your business better. They're not ends in themselves. The goal is a sustainable, profitable agricultural enterprise that meets your family's goals and serves your community. Thank you for joining me on this journey through financial management for agribusiness. We've covered a lot of ground today, from understanding the 3 core financial statements to analyzing your farm's performance through profitability, liquidity, solvency, and efficiency metrics. Remember, financial management isn't just about keeping records for the tax authorities or the bank. It's about gaining the insights you need to make better decisions, build a more resilient business, and achieve your goals as an agricultural entrepreneur. The tools we've discussed today transform farming from a hope-based activity into a management-based business, where you can say with confidence, according to our projections, we'll achieve our goals if we adjust these specific factors. Start small. Begin by creating your balance sheet, tracking your revenues and expenses, and monitoring your cash flow monthly. As you become more comfortable with these basics, gradually incorporate ratio analysis and benchmarking. Financial literacy is a journey, not a destination. Keep learning, keep growing, and remember that behind every successful farm is a farmer who understands not just the land and the crops, but also the numbers that make it all sustainable. Thank you, and best of luck with your agricultural business.